I worked as an analyst in investment management for 9 years, and these are my top 10 investing mistakes. Investing with debt. So this is where you're going to take out a loan with the idea that you're going to invest it into the stock market, and you want to get a better return in the stock market that you're going to pay back on the loan. It used to be a lot more appealing than it is today. Interest rates before, you could probably borrow the money around 3 or 4%. Today, it's up towards 7, 8, even higher in terms of what you're going to pay back on the loan. In terms of the stock market, there's just no guarantee that you're going to get those returns long term. And you've also got to remember that you're going to have to pay monthly repayments on the loan. Not having a long enough time horizon. This is where you set your expectations too high in the short term. So if you're expecting to get a return of 20, 30% in your first year, it's just going to be unrealistic. The longer you can set that time horizon, it allows you to ride out volatility. So you're not looking to sell at the wrong time potentially, and it allows you to ride out those peaks and troughs. The longer you can stay invested in the market, the more likely you are to get a positive return. You're also less likely to make tweaks. This is where we can make mistakes as well. We can overtrade by trying to make too many little changes. That's where we can try and time the market at the wrong time. And actually, it would just be better sitting back and let it do its thing. Paying too much attention to market news. So markets are dynamic, they're fluid, right? They're always going to be moving. And you've got to make sure that you're not paying too much attention to the rhetoric that news agencies are always going to be putting out on a daily basis. Remember what their agenda is, right? They're wanting to get clicks, they're wanting to get views. So yes, of course, there's interesting things that you need to be aware of. But going back to the previous point, if you've got a long enough time horizon, then you're not too concerned with short-term volatility. You've got to make sure that you're not getting caught up with some of the hysteria that comes with some of these news agencies and some of the articles that they put out. It's just going to overwhelm you. It's going to drive you crazy because you're constantly going to be looking to make little changes, make little tweaks, when actually you can just sit back. You invested for a reason. You've had a long enough time horizon. You can let it do its thing. Chasing high returns and trying to beat the market. I think there's a naivety with retail investors where we think we can beat the market over the long run. So we start picking single stocks thinking, oh yeah, this is going to get a better return than it would just be putting my money into an index fund. And while that might work for the short term, what's to say that you're going to keep doing that over the long run? There's very few professional fund managers that can beat the market in the long run. I think it's fine to have a small percentage of your portfolio in some of those single stocks. You know, it can be quite interesting if you want to play around with it. That's absolutely fine. But I think you've just got to go into it open-minded that you are taking on more risk by doing so. Investing because markets are going up. This is all about FOMO. You're looking to get into the markets because a stock is going up in price and you don't want to miss out, right? So you start going in. The problem with this is that you're going into it with the wrong reasons. So you've got to make sure that what is your plan? What's your exit strategy? What if that hype is short-lived? How are you going to feel if you got in at the wrong time and you got in towards the top and then it starts to correct? It's going up for a reason, but you have to ask yourself, like, is that going to continue? Because it's so easy just to think, oh, this is going to carry on for another year. But have you done enough due diligence to say, yep, this is going to continue doing the same thing, and you're investing because you've got specific reasons, rather than just buying the same asset for a more expensive price? Investing because a friend bought something. This is all about making it specific and unique to you. They might have totally different circumstances to you. They might have a different time horizon. They might have a different amount of disposable income. They might have a different risk tolerance. They may need to sell the investment at a specific time that is not always going to be conducive to your plan. So you've got to make sure that you're doing it for your own reasons. And yes, you can take advice, you can chat to friends and that kind of thing, but make sure you're doing it for your own reasons. You've got your own plan, because if you just copy others, it's never going to be as specific as doing it for yourself. Knowing what you own. And this kind of follows on from the previous point about having specific reasons about what you're investing in. Now, if you just want a hands-off approach and you go into an index fund, that's absolutely fine. You're going into it because you want a passive approach. You don't want to have to keep making constant changes to it. That's why you go into those. But if you're picking single stocks with the idea that you want to beat the market, have specific reasons about why you're investing into that company. If you're getting into a company that you don't really know what they do, you don't really know what their earnings are like in the last few years, well, then you haven't really done enough due diligence to say, yes, I think this company is going to go up. Have specific reasons about why you're investing into it, and know exactly what you're investing into. Getting complacent and having recency bias. So I think the most obvious example of this is in the tech industry right now. So if you were to look at the S&P 500 since the 1930s, it's averaged around 10%. But over the last 5 years, it's averaged 16%. And it's very easy to get caught up with, oh, well, it's done this for the last 5 years. What's to say it's not going to continue? And you set your expectations around this is going to continue getting those same returns. And the longer we go without seeing a massive market correction, the harder it is to really visualize what that's going to look like. So in the early 2000s, we saw the dot-com bubble. In 2008, we saw the housing market crisis. In 2020, we had a short-term correction in terms of the COVID pandemic. That was very short-lived. And I think the longer we go on from these, people forget about what that time was like and what that experience is like. And they just see the recent returns and think, oh, this is going to be absolutely fine, this is going to continue. You invest then for the wrong reasons, and then you might pay the price later down the line. It's not to put you off from investing, but it's going in with the expectations that the most recent returns may not be what the returns are going to be over the long run. Confirmation bias. So this is where you go out and look for articles or other opinions that back up your own opinion. It's very easy to do. Like essentially you can go onto Google and essentially search for anything that's going to back up what you already believe in. But when you think about it, is the only reason you're doing that to make yourself feel better and make yourself feel better about that decision? What you could actually do is do the opposite. So search for opposite opinions. No one really likes to do this because they don't want to be put off from making that decision. But remember, have a specific reason about why you're investing into something, not just because someone else says this is a good idea. Of course, it's important to have a balanced approach, but just make sure you're getting enough opposing views as well as views that also agree with your existing opinion and decision. Trying to time the top. Now, this is different if you're looking to sell for a specific reason. So if you invested for the long term and you need to then take some risk off the table and you want to buy a specific purchase, well, then that's a little bit different. But if you're just trying to time the top in terms of you think the market is overvalued and you're wanting to make some trades to take some risk off the table with the idea that you're going to buy back in a few months' time, it's a very risky strategy. Remember, when you get an all-time high, that's because there's momentum in the market. There's nothing to say that that momentum is not going to continue, because you could try and time the top thinking, oh yeah, this has gone up for a long period of time. The market could then continue going up for another 10%. Even if it then corrects, 8, 9, even up to 10%, you're still in a very similar position than you would have been if you just held that investment over the long run. So I think sometimes trying to overtrade and trying to time those tops can be a risky strategy. What you can do if you do want to try and do this is, rather than trying to put 100% that you sell, do it in little batches. So to put like 10%, and then you try and average out just the same way that you would average in. So if you're regularly investing, you're investing monthly, that's what you call averaging in. So you're not always putting all your money in at one time. You're spreading that over a period of time. Well, you can do the same thing in terms of averaging out. So if you're looking to take some money off the table, don't take 100% all at the same time. Do it in batches of like 10 or 20%. And then you can average that out and reduce your risk of totally missing the top. That's my top 10 investing mistakes. If there's any that you would have included, then let me know in the comments. Thanks for watching, guys. I will see you tomorrow.